You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome to the Infinite Banking Mastery Podcast. Thank you for being here. I appreciate you listening in. Today, I wanted to just cover maybe a shorter topic, but I wanted to cover the topic of an infinite banking style whole life policy versus just a traditional regular style whole life policy, which the more traditional regular style is what most life insurance agents out there would create. If you were to get together with a life insurance agent and you were to ask, can I get a whole life policy? Or, if you're asking about the difference between term and whole life, they would create these illustrations for you. And this is the way most commonly that people build their whole life policies. And one of the reasons, too, why I would say the financial gurus out there don't like it, because they think it's just a terrible place to put your money, or they say it's a terrible place to invest your money, which of course it is, because life insurance is not an investment. It is an asset. So remember, with infinite banking, we are housing our money there as opposed to housing it with a bank. And then from there, you can invest it however you want, or use it for whatever you want. Pay off your house, pay off some debt, pay off some real estate you want to invest in, or, whatever you want to do. It's just a holding tank that's going to be way more efficient and do way more for you than your bank account. So when you're building a policy that is just a traditional, I would say, regular style of whole life policy, what we're doing is we're asking the question, like, how much life insurance do you want for the coverage of your family? Or if they're saying, I have this much money, I want to be able to buy life insurance that I will not outlive, that was going to be guaranteed to outlive me, so it's going to last my whole life. And they give you a premium amount, and then I would just enter that right into my software, and it would spit out the death benefit. So when I'm doing that for just a regular policy, because somebody just wants a good death benefit, I would put that number in, and that amount of premium that I type into my software would be the cost of the full death benefit. So the death benefit would be reflective in the price. The price is reflecting the actual cost of the death benefit. So that means that the death benefit is costing the entire premium. So in that first year, after you've made that premium payment, there's no cash inside. You have no access to any cash. I mean, the cash value after the first year, after a full premium went in, would be zero. Maybe it might be a few dollars, but most likely zero. In fact, I have an example of, say, someone age 45 and someone's putting $40,000 a year into a policy because they're wanting to do it for infinite banking. And if I show them, well, here's the two styles, so you could see what it's like, what all those financial gurus out there are telling you it's a bad idea. Because when I illustrate it the more normal way, there is $0 year one. And so people would say, yeah, why would I put my money in there? If for the purposes of growing cash when I have none after the first year. So that is a major difference. That's why it's important that you work with somebody, that you meet with an infinite banking practitioner who knows how to structure these in a more cash efficient way for you, so that you know someone who will build it in the correct way for your policy to build cash, rather than for the whole premium amount to go towards the death benefit. And so when we're building for infinite banking, remember that we are shrinking down the death benefit. And so that same $40,000 premium that goes in, depending on age, depending on your health, all sorts of things. But roughly, you would have access to maybe somewhere around $24,000. So you put this $40,000 premium in, and year one, you have access to a large chunk of money. Now, you might not have access to all of your money year one, and that's because of the startup costs of your system. And so there are startup costs for your banking system, just like there are startup costs for any business. I know I've told this story before. Starting a business does cost money. You got to put money into it to be able to have it yield you cash flow. And so with the banking system, it is the same. It takes a few years to kind of catch up with that, get over that startup cost hump. And then from there, it will become cash flowing and just be rocking and rolling and be awesome from there. But in the first year, you have access to a large amount of your cash with an IBC, an infinite banking style policy, as opposed to just the regular style. And so again, if we're looking at a more normal traditional style of whole life policy where you put in a large amount of premium and in the first year there's $0 available, with those style policies, you are getting a much larger death benefit because that's what's happening. Your whole premium is buying up the true value of the death benefit. So when you're buying a infinite banking style policy, we're shrinking the death benefit. So the death benefit is much lower because we are purposely shrinking it down. So that's the two differences there. And then with the traditional style, you have that cash is slow to grow. The cash that you have access to is growing more slowly. Like you have not as much at the beginning, although you will have a lot of cash build up over time because starting with a premium of, say, that example of 40,000, that's just your premium going forward. We're not reducing it. We're not doing anything. I mean, it is possible to reduce if you need to later, but generally that's just your premium for the rest of your time paying that policy, whether you're going to pay it for 20 years or for up to age 75 or to age 98, which most whole life policies have premium to age 98. And so you have this premium going in, and in year one, you have access to $0. And then in year two, after you pay another $40,000 into the contract, you would have access to maybe a few $100s, maybe not very much still, because this policy, the cost of this larger death benefit simply is that premium. So it takes a lot longer for the cash value to build up. Now, with the infinite banking style policy, remember, we're building that on purpose to have your cash be efficient. So when you're paying into that, you're paying an amount of cash over and above the actual cost of the death benefit. So the death benefit costs one thing, and then you're putting in money over and above that cost so that you can get this policy to be really efficient and then just start steamrolling like this big snowball that just starts collecting snow as it's rolling down the hill. So you have this you're piling up, you're stacking in cash over and above the cost of the death benefit. And that extra cash does not have a fee with most companies, and depending on how you structure it, doesn't have a fee draining out of it. So that's what's helping it to pile up and get bigger faster. So with that style of policy, you have access to more cash right away, more cash sooner. And then later on down the line, you're not going to want your policy to become taxable. We went over this in a previous episode. And so in order to keep your policy from becoming taxable, you will have to lower that premium down at some future year. And so that is one reason why your traditional style policy will end up later on down the road having more cash in it because your premium started off higher and it stays higher the whole life of your policy. Whereas the infinite banking style will end up dropping down. You'll end up reducing your premium, but it's going to be more cash efficient. And in the long run, you're going to end up seeing in the infinite banking style policy how much more efficient your dollars were as compared to the amount of premium that you've paid into it. So you can see how much premium you've paid in, you can see how much cash value you have access to, and you can see how much more efficient and how much more growth there is when you build it for the purposes of banking with it, for the more efficient style of putting extra cash over and above the cost of the insurance. Helps it to steamroll and just grow more efficient. And then you have this big pool of cash to use and utilize however you see fit. So you've been hearing me, I threw around this $40,000 premium number. I just got that number because it's the number that Nelson Nash uses in his book for one of his examples. And so I oftentimes use that when I'm explaining and teaching people, because when they're reading the book, then they can see this. I'm using the same example, the same numbers that Nelson Nash is using. So that doesn't mean that your policy has to cost $40,000 a year, or there's no such thing. It's really whatever makes sense for you and your budget. So it just depends on what makes sense. So we would get together, we would chat, we would talk about your overall financial picture, and then would figure out what makes sense for you, what kind of premium makes sense for you, what fits your budget, what just fits your overall financial picture, your financial plan, your financial goals, and go from there. It's definitely not just some number that you have to be able to put in. It can be any number, essentially. And so another thing I wanted to point out is that the paid up additions, when you're putting in that extra cash, remember the paid up additions is the excess cash that's over and above the cost of the insurance. When you're paying that in, it is buying up death benefit. And that means buying and paying for, like it's paid for, more death benefit. So the death benefit increases pretty fast, pretty well in those years when you're paying that paid up additions amount of premium. And so you can watch that death benefit go up very well. And then once your paid up additions drops off, your death benefit still continues to grow. It just grows a little more slowly. And so a lot of times when I'm with clients, I will sometimes just show them the difference because they'll tell me, oh, well, so-and-so says it's a bad idea. Don't put your money in whole life. And they say it's not a good place to grow your money. And so I will just pull up the two examples. I'll say, well, here's why they're saying that, because they are referring to this other style, which is the more common, the more traditional way to build whole life. And that's why they don't like it, because they see that there's no cash available in that year one. And it doesn't make sense to them. But I would say that whole life is good regardless. So if you have a traditional style whole life or you have one built for IBC, whole life is good. It's a good thing. It's going to just get better with time and grow. And the younger you start a whole life policy or any investment, really, the better it is for you, because time is your greatest asset. And so the longer you have it, the better. And so when I see clients or when I'm talking to them and they're telling me, well, I have a whole life policy, I like to look at them and see what's going on. But I never really, once, I would say almost never would tell somebody to cancel a whole life policy. Whole life policies are good. If you have one, you've already have it. You have those years built up, and you should keep it. Even if you want to build it a different way, you want to start a whole life policy that's meant for infinite banking, then we can take a look at how we could work with that with what you have, or restructure what you're doing. Maybe find a way to keep the policy, but fund another one more heavily. And there's just different things that we can do. But generally, if you have a whole life policy, you should keep it. You should keep it. It's going to be good. It's going to be better the longer you have it. And so it's a valuable asset to retain. Well, that's all I have for you today. I just wanted to give an episode where I'm just touching on the difference between the style of policy that most people out there would say, the reason why they're saying it's not a good place to put money versus what we're doing. It's very different. And again, I would encourage you to pick up Becoming Your Own Banker by Nelson Nash to get a good foundational understanding of that. And then reach out to me. Send me an email, shoot me an email at valerie@alphaomegawealth.com. I would be happy to connect with you, chat with you, see if there's a way to structure a policy like this for you and just help you in your learning journey. So I look forward to talking to you again next time. Hope you have a great week.
This is thepodcastfactory.com.